All right. So thank you all for joining us today. I hope everybody's enjoyed, the other introductory sessions to this Financial Inclusion Week, and I know there's many more to come. So thanks for joining us for this discussion on positive friction today. So my name is Colin Rice, and I'm a senior research specialist at the Center for Financial Inclusion. And I'm joined today by two other great panelists, Hilda Mora, the CEO and founder of Pezesha, and Rebecca Rouse, formerly with USAID and now with the World Bank. So I'll give them a chance to do a brief intro in a bit. But I did want to get started today just providing some background and context to the conversation today. And so we're here today to talk about the concept of positive friction, and specifically to review an experiment of how this concept can be applied in the context of digital credit. We will discuss later on some other potential uses or areas for further exploration of this sort of idea. But the bulk of our discussion will be focused on an experiment we undertook with Pezesha and supported by USAID. So before getting into kind of the experimental details and sharing some of the insights, I did just want to quickly put this kind of in context of Center for Financial Inclusion's wider work to develop consumer protection by design. So we know that consumer protection is often viewed as a compliance-driven activity and is, very often providers reacting in response to a set of standards or guidelines from regulators, from investors, from others. This would include things like the client protection principles or other initiatives. While these types of guidance can certainly provide, very solid insight, solid guidance, and help people establish the right practices and policies, given the developments today and the increasing complexity and the types of providers and the channels for digital financial services, and really just the pace of change that we're seeing, I think it's become clear that there really is a need for new types of approaches to really ensure that with continued expansion that there is trust is being built and maintained in digital financial services. So kind of with that in mind, we really have sought to look at how consumer protection can be embedded into the design of products and services to drive positive outcomes for both providers and consumers. So again, for a little additional context, so we know, in digital financial services and digital services more generally, kind of the term frictionless has really emerged as a guiding principle of some ways. There's been an aim by product designers to really reduce the requirements, the number of steps in a customer journey, and the speed of review of loan approval or of application for other types of services, and often really done in the pursuit of rapid growth and customer acquisition. Now, we know that this is generally valued by consumers. They enjoy the speed, they enjoy the convenience, but we really have to consider kind of at what cost are some of these steps being taken. We know also that these actions really reduce the amount of time and the number of decision points that customers have to really understand and engage meaningfully with products, terms, and conditions, and to really consider its value or its suitability to their needs. And so when we think of how does this impact consumers? So again, we know that consumers value the speed and convenience of digital credit and of frictionless digital services in general. We know that these kind of design choices have helped to drive access and usage, to higher and higher levels. But we know they're often, that people are often, lack clarity on the actual cost and obligations they're taking on with these products and services, and that less informed consumers are going to have worse repayment rates and, be able to elicit less value from these products and services. So I know Hilda will get in a bit later to some more kind of context for Kenya specifically, but just to give kind of one example of kind of why this is an issue in that market, we can look at the usage of Fuliza, which is a small and short-term overdraft loan for M-Pesa users who have insufficient funds to complete a transaction. And there was a study in 2021 showing that Fuliza was processing 300 overdraft requests per second in that year. Again, just kind of indicating the prevalence and wide usage of kind of easy digital credit, and also, the usage of these types of products in context where customers may be having other challenges with managing funds and things of that nature. So in that context, what is positive friction? So positive friction is steps that are introduced to intentionally slow users and shift them out of automatic thinking to allow them to make more considered decisions that can help achieve positive consumer outcomes. So we know that there's other kind of design attributes and choices that are made, things like nudges and sludges, which may be used to direct customers to certain products or services or to make certain types of decisions. And we do just want to clearly distinguish, positive friction is, using a lot of these same ideas and concepts, but specifically with the intent of driving positive consumer outcomes in how they're used and where they're applied. So I think to maybe help crystallize this idea a little bit, I wanted to share a couple examples from outside of financial services. So one from a very different kind of area is, the use of blister packaging. So, previously Tylenol was sold in pill bottles with loose pills on the inside. And in the UK, this is from a number of years ago now, but they found that by introducing blister packaging or individually packaged, medication, that they were able to have a significant reduction in the number of suicides by use of Tylenol, as well as accidental deaths and liver problems that come from Tylenol toxicity. So again, while this is a very different context, it's just meant to show that this intentional friction and kind of small design changes can drive really significant impacts and changes to how consumers engage with and get value from a product. Another example that I think everyone will be much more familiar with is email attachments, and the idea that if you go to send an email and have the word attached, in the message, in the body message, you'll get a pop-up that's double checking, did you mean to attach something here? And again, that's just a very simple, example of how a little bit of friction, something which is meant to slow down time, but is meant to drive, the positive outcome, what a consumer actually intends and needs from a product. So when we think of this in terms of, how was this applied to digital credit? So we can see here, this was part of the experiment done with Pezesha, the Kenyan digital lender. And we tested this concept by introducing a very brief 3-question quiz to their loan application. So I know the text here might be a little hard to read, but overall, the quiz itself starts on the fourth screen here. And we selected questions for this quiz in coordination with Pezesha, based on topics that would be particularly relevant to customers in terms of their understanding of loan terms and conditions, and that they would be salient at the time they were encountered. So we asked customers for the total amount payable on their loan, the due date on the loan, as well as the penalty for late payment. And as customers, came to approach this platform,
Pauline, I don't think we can see the slides.
Okay, sorry about that. So you can see here, so the introduction of 3 quiz questions into this loan application, again, starting on the 4th screen here and going towards the end. And again, as customers went to engage with the application, they were randomly selected into the treatment or control group. So half encountered this quiz, half did not. I did also want to note that performance did not affect access. So if someone did encounter the quiz, they potentially could have gotten every question wrong and still have access to the loan. So this was not intended to prevent access to credit. It was instead to give customers the opportunity to engage with the loan terms and conditions and check their own understanding and familiarity with them. Another kind of key aspect of this experiment was that Pezesha was seeking to explore whether they could serve a new segment of customers, of smaller MSEs. And so they did this as part of the experiment by lowering their loan criteria. So it was a lower minimum credit score, lower monthly income, and reduced requirements for business documentation. And again, this was intended for Pezesha to be able to access and serve a new segment of customers without bringing undue risk to themselves or putting undue stress on the customers. So, now seeing kind of how this worked in practice and, what this looked like from the consumer side, I'm going to quickly share just some of the kind of key results from this experiment, and then we'll get into discussions with the two panelists about some additional considerations in terms of the designs, how the results were interpreted, and really where we can go from here. So, quickly, we see here on the left the demographics of the different samples. And I will note that the sample size did not achieve statistical significance, but we still feel that it shows, strong directional indications of positive impact on customer behavior and on value to the business. So you see on the left, the demographics, the samples were very closely aligned in terms of kind of basic demographic features. And then we see some of the highest level results on the right side. So we focus the analysis primarily on first-time borrowers. Given that their first encounter of the quiz, again, it would be the most salient, as well as that repeat borrowers have already demonstrated, some ability to repay and to be, responsible managers of their debt. But we can see here that consistently, on the right side, the treatment group performed better than the control in terms of being late on repayment at any time, in terms of, reaching a level of par 30 or above, or a loan write-off of par 90 or above. And so again, the effect kind of decreases with those longer terms, but we do see, again, kind of the consistent better performance of the treatment group. And in particular, I wanted to note the impact on those newly included customers. Again, this was the customers who were previously would not have been able to access products through Pezesha, but given the lower credit scores, lower income requirements, they were able to access this direct to MSE product. And we found that among these customers, the strongest impact on their ability to repay. So we see that among the treatment group, 47% of those newly included customers had a late repayment of 1 day or more at any point, compared to 61% from the control group. And then when we look at those who had a late repayment of 30 days or above, we again see only 40% in the treatment group experienced the late repayment above 30 days, compared to 48% in the control. And again, while we see this for other, clients with other credit scores as well, we did find a stronger impact among these newly included and riskier borrowers. I would also note, we've recently released a full report on this experiment, which is available on our website and provides, significantly more detail on the design and on some other results. But we did also find that there was a greater impact among women borrowers as well, with a larger difference among female clients in the treatment group compared to the control. So, just as kind of a final overview of some of the impact across the sample, again, most of the analysis was focused on those first-time borrowers and specifically looking at those newly included. But when, Pezesha shared some of their impact metrics from across the sample, across the experiment, we found that there was a 90% quiz accuracy rate since implementation, meaning that people are, largely familiar with those different terms and conditions they were being quizzed on. We also see that, among the treatment, there was a 10% increase in the on-time repayment rate, a 15% decrease in the portfolio at risk above 90 days. And then, again, while performance did not decide whether or not they had access to the loan, we did find that those who got 3 out of 3 questions right did experience a 12% higher repayment rate. So again, given the limited sample size, we did still feel that there was strong indications of the positive impact, from this intervention, again, in driving better repayment behaviors among the consumers and also improving portfolio quality for the provider. So I'm going to go ahead and pause my screen sharing there, and now throw it over to some conversations with the other panelists. So Rebecca, I'll start with you, and I think first maybe you can just give a very quick introduction of yourself, and then would be interested to hear you kind of just start talking a little bit about, what were really the overall goals of this experiment and what was the significance of making sure we demonstrated value both to the consumers and to the provider.
Great. Yeah, thank you so much, Colin and Hilda, for the opportunity to join this panel. I will say before I start talking that I'm here in a personal capacity. I don't represent the views of USAID or the World Bank. I'm here for the love of the game. But I previously served as the team lead for digital financial services at USAID, and oversaw this project from the USAID side. So this project was funded as part of Digital Frontiers, which was a USAID program that advanced the use of digital tools for development and building digital ecosystems. So for the digital financial services team, we're really interested in understanding how this shift to digital creates opportunities, but also potentially could create threats or dangers to consumers. And we wanted to understand how we as donors could contribute to an inclusive, safe digital ecosystem for financial services users. I think the latest Findex findings from earlier this year really demonstrate the impact that that digital products are having on financial inclusion and behaviors such as savings and formal products, as well as access to different types of credit products that are facilitated by new streams of digital data, new delivery channels, and a lot of really exciting stuff happening in this space because of the ability to generate and use new types of data. At the same time, we're also quite aware of risks that some of these innovations bring. And Colin, you mentioned this a lot in your opening. I think it all comes down to this idea of speed. Speed is the name of the game. Instant payments, instant loan approvals. We have now as consumers higher expectations for how long some of these processes should take. And I think there's been a lot of obviously positive developments in building faster, interoperable, more efficient products and services in this space. But speed can also be used to harm. So we see obviously a rise in scams and fraud and in the digital payment space related to the nature of fast payments and what are sometimes irreversible payments that are instant, right? So we're trying to better understand how to build this ecosystem that provides all these amazing benefits for consumers, while at the same time ensuring that the ability for speed and instant approvals, instant payments don't end up harming consumers in the end. So, I think this was an interesting opportunity for us to understand how, as you said in your intro, how fintech providers can actually think about speed and think about user experience and user design in a way that could help to improve borrower outcomes ultimately. And I think that, obviously policymakers have an important role to play here, regulation, all of these things. But at the same time, we don't want to put the onus just on policymakers. We don't want to put the onus just on consumers to make the best possible decisions for them when there's so many things that are kind of stacked up against them potentially. So we wanted to demonstrate a way that smart user design and user research could help to improve consumer outcomes in a way that was implemented directly by a fintech. So I'll just say, I think there's obviously a lot of evidence that behavioral design matters. Even if we think we're designing a product without including a behavioral nudge, the joke's on us, because we are. Every single choice that we make in the design of a product or experience will have an impact on the way the consumer reacts to it or behaves. And large companies know this. If we have used, companies like Amazon or Facebook or Netflix, they all know these things. And we're part of experiments every day that they're doing on us to understand how different small changes in the user experience might impact the way we, purchase things or, look at different types of information. We were all probably part of several A/B experiments today, even if you looked at your phone or did anything online today. We want to make sure that companies that are, companies that donors or impact investors are interested in working with have the same capacity and know how to be able to do that same level of really advanced user testing. But hopefully in this case, not to Well, yeah, I mean, actually, to sell more items, we do, like you say, want a win-win for the consumer and for the business. But I think it's really important to understand and demonstrate how these types of companies can actually leverage that research to get those beneficial win-wins, and not leave it up to the Facebooks and the Amazons of the world to have all the sophisticated research and testing. Over to you.
Great. Yeah, no, I think a lot of good points there. I think it is, in terms of, like you were saying, coming up with solutions that is not about putting the impetus on the consumers or even providers or any specific stakeholder, but rather coming up with tools that allow kind of each stakeholder to be able to drive those outcomes. And I think also, yeah, the idea of that there's no neutral design choice kind of thing. That there might be providers and things making choices that aren't based on driving acquisition, but if you're not trying to embed thoughts about consumer protection and things in those design choices, just because you're not aiming to design something away from those outcomes, there still is a responsibility to being thoughtful about that. So I think with this kind of compared to other initiatives and things you've come across, I guess as a funder, what was kind of particularly appealing about this specific approach or this specific experiment that maybe brought you on board at that phase, or what maybe seemed like separated it from some other approaches?
Yeah. So I think what's exciting about this type of research is it's the ability to see how people are going to react in real time. People are going to reveal their true preferences when they're actually making a decision or using the product. I think all levels of user research are important, doing survey work, doing focus groups, other types of qualitative work to understand the preferences and choices and needs of customers. And all of those things are important pieces of the product design process. But it really does take that kind of real time, testing to understand how people are going to truly behave when they're faced with a decision. And so I think this was a really exciting opportunity, to have Pezesha open their doors to the research team to be able to do that and be open to making some modifications to the way that they were operating to allow the company and the researchers to observe those reactions in real time. Because I think, that could often be a tall order for a business, and they are focused on their bottom line. They have lean teams. They don't have the time or the resources to be able to do that. They don't have access to, researchers who can come and guide them. So, I really do applaud Pezesha's openness to experiment in this way, because this really is the best way to see how customers will react to these types of changes.
Yeah, I would second that. And shortly we'll hear from Hilda about some of those kind of considerations they were making internally. But yeah, the importance of having providers like Pezesha willing to kind of explore these kind of initiatives and use that to elevate understanding in the sector is key. I think before going over to Hilda, maybe a final question for you for now, Rebecca, would just be, in terms of the significance of having, donor funding available to kind of build this sort of evidence, and especially testing initiatives that other types of funding sources may not, see as established enough or see that kind of benefit. So maybe just talking a little bit about the significance of that, especially in the kind of shifting funding landscape we're in today.
Yeah, no, thanks for that question. And I'd love to get Hilda's thoughts on this as well, in terms of where do you look for evidence. But I think there is a need to have a body of work out there that companies and donors and impact investors can pull from to understand what are best practices in product design. What types of impact outcomes might we expect if we do X, Y, and Z? And it's not easy to produce that research. For anybody who's worked in this space, it's time consuming. It's potentially expensive. It diverts effort from your main business. And so there is an important role that donor funding can play in building that body of evidence and creating the resources, providing the resources and creating the incentives for all of the ecosystem players to work together to generate that evidence, not just for their own business, but something that is a public good that others can also pull from. In this kind of context of maybe limited donor funding and donor prioritization into other areas for funding. I'm interested to know kind of where, Hilda's thoughts, for example, on where companies can step up to continue to generate this evidence and share learnings. What role do impact investors play? I think that's another really important stakeholder group where, impact investors also want to be able to understand what kinds of impacts the products that they're supporting are having on end users. And so, but that's not part of their main business, their core business anyway, as investors. And so, where can we figure out new ways of collaborating between investors and the private sector to make sure that lessons are still shared publicly, that we do create this body of evidence that can inform future work. I think a single study isn't enough, and especially as you mentioned for this study, for example, we didn't have the statistical significance to really be able to say anything definitive ultimately, in a scientifically valid way about what the results were. But at the same time, behavioral interventions like this, the impacts can be subtle and vary depending on the context and the provider. And it really is important to build a full kind of library of evidence where we can look across different contexts, look across different types of implementation, and try to understand really how some of these behavioral interventions behave. And so, I would say there's absolutely a role for donor funding in that space, but we should be looking towards the impact investors and the private sector now to understand how we keep that rolling.
Great, thanks, Rebecca. So Hilda, now I'll come over to you. So I think first, I don't know if you want to respond to any of the points Rebecca made, although I know we'll kind of be touching on them throughout the discussion as well. But yeah, maybe if you just wanted to give us a quick introduction and a little background on Pezesha, and then maybe kind of a little bit about the market context, kind of in what you operate and what might make this sort of approach or initiative kind of relevant in the Kenya market.
No, awesome. Thanks, Colin. And of course, Rebecca, glad to be in this conversation with you. I mean, for the first time, we also, while doing this experiment, we were basically understanding what is positive friction in our world, which for us, this experiment was not just to bring, that inclusivity or additionality into the way we do things, but also it's really shaped our business in the last couple of months. Yeah, I mean, I'm really excited about the outcome. But before I go into the depth of it, I'm Hilda. I'm the CEO and founder of Pezesha. Really, this study has brought in quite a lot of value, but also a lot of learnings for us as well as a business. Considering the market that we operate in, this is micro businesses that we support. 90% of these businesses are already rejected from a traditional financing level. Because they don't have credit history. The data is fully fragmented in most ways. And we are seeing majority of these MSMEs that are rejected are women. More than 40% are being rejected compared to the male counterpart. And access to credit, basically, as much as it's growing, especially in the formal space, we continue to see that because of these nuances where we operate as Pezesha, working with micro and small businesses, the rejection levels continue to actually widen, especially in the current macro situation, and mainly because of the same reasons I mentioned earlier of information asymmetry. These micro businesses basically operating under thin files. The ticket sizes are really micro and small, but of course, at the same time, they haven't borrowed credit before. We see that fragmentation, even from a credit bureau perspective. They don't have a holistic picture for us to better assess them for the first time that they come into our door. And then, of course, that means that we don't have that holistic picture of their over-indebtedness. And what we've seen from the 1 million MSMEs that we're working with, this picture is now telling us that more than 50% of these businesses at the micro level are actually loan stacking. And what we're seeing is the ratio of their income to loan is basically around 50%, which is concerning because they don't have a credit history in the credit bureau. Their M-Pesa data is still not enough for us to understand their credit history. And so the question is, where do we lean on to really get their full picture, to include them for the first time into our financial ladder. And then lastly, and majority of it is also because of the lack of financial literacy that we continue to see, as Colin, you've mentioned, Fuliza and the other financial products that are actually taking precedence into this picture. 30% of these businesses at a micro level are still betting, which of course raises a lot of concern, whether the capital that we are providing at scale will continue to impact their business, considering the ratio at which they're borrowing and saving is still very, very concerning as well. We're only seeing less than 10% of them actually saving. So, Colin, I think what I'm trying to say is we have lent and collaborated and interacted with more than 1 million small businesses, both in Kenya and in Uganda, to be able to actually see, the behavior which translates to the same behavior we continue to see at a macro level as far as these businesses are concerned. Now, why we are so excited about this study, of course, is because it now helps us to look at these challenges or insights from a market perspective and ask ourselves, how can we solve and bring financial literacy, customer education at that level to really help these businesses that are so risky that we deal with to be included in the financial system. It's not easy because it's as much as we are a business that focuses on consumer first, we've had to balance it, of course, with really understanding how we reduce these frictions, but also making sure that we are lending responsibly and we're also promoting responsible borrowing at the same time, both in the markets that we operate in Kenya and in Uganda. So for us, we want to think about how do we make sure we include these businesses as much as they're risky, but also how do we make sure that we scale as a business. And so this particular experiment has played a very big role in really helping us to balance that equation. It's not been easy because majority of the businesses we work with to access this data, they are within an embedded network. Mm-hmm. And now we wanted to actually explore these businesses that are outside these value chains as another channel to reach them. And so we saw this experiment as a way to actually, tapping into these underserved, excluded businesses. In most cases, we were lending to them for the first time. So we're really excited, for us to solve this problem holistically and also to share our learnings to the world to actually start thinking about these micro businesses in a different way.
Great. Well, yeah, thank you for that background. Yeah, I mean, I guess, given the circumstance and the extent of your other products and services and everything, I'd be curious to hear a little bit more about, what was it really about, this experiment that kind of encouraged you all to come on by? Like, what was Pezesha really hoping to gain from this? What kind of was able to convince you and your colleagues that, this is worth pursuing? And I think also maybe touching a little bit about, once you were onboarded, just a little bit about kind of the resource requirements or, what it required internally to actually implement it compared to kind of the benefits you hope to see.
Yeah, I mean, of course, SME has a big potential in terms of the impact that we see as a business, because that's our mission, to basically help businesses to access affordable credit and drive financial inclusion, especially for women businesses that we continue to see our own particular models continue to reject them just because of these challenges that I have already mentioned. And as we move from one market to another, we continue to see those fragmentations. There's a lot of similarities and frictions and inefficiencies that we felt, this particular project aligns with how we want to look at data-driven strategies that can actually strengthen the direct SME as a channel to how we reach these businesses, especially in markets like Uganda, where we've seen there's a lot of fragmentation on data. So the alignment of the mission that we do at Pezesha, which is support small and medium businesses to be included, and not just to access credit, but also sustainably to look at how we scale as a business, was really the main driver, where we were very excited. And in the end, the outcome we wanted to achieve from this study is, of course, being able to scale in markets where we have many informal micro businesses. They're very risky. Where do we start in making better financial decisions? And at the same time, that translates to lower default rates and better portfolio qualities that then allows us to scale as a business. Because in the end, if we see so much risk, and I'll speak to the aspect of what are some of the considerations as well. I mean, when we look at the risk that we are exposed to as a business, for the first time we are lending to a micro customer, it's really very high, because again, we're just almost making a bet about their behavior. And so we wanted to see the outcome of this study. Of course, as much as we want to reduce our rejection rate at that level, we still want to make sure that we are lending to quality customers, and translates to also growth mechanisms, or ways that we actually figure out how do we then increase the conversion rates, especially because majority of this business actually don't end up making it through to the end of our loan cycle process, either because of the requirements that we require for the first time, the documents we need with their consent, access to the data that we need to pull from different databases. And so for us, this was right timing when the project came in to experiment, because we were looking to scale up and really enhance portfolio quality to the next level. And in the end, as our mission says it, for us, it's all about responsible lending, as we work together with partners to achieve that. Now, from an implementation level, it was a very interesting experience, because one of the key things for us was how we needed to collaborate as internally with the different teams. So it wasn't just about the data team looking at the data we were collecting, but also the product team had to be involved in this project. We had to involve the credit team, and we had to also involve the UI UX team. So there was a lot of collaboration, which is a bit different from what we've done in the past, where we've seen only one team. If it's data science team, only one team is involved in running the project end to end. But for this particular project, we actually had to pull in almost everyone in that cycle of the journey we take our customers, and the entire customer journey, from the start of KYC to credit scoring, to disbursement, up to collection. And all that required a lot of resources, and of course, one of our recommendations is ability to actually find risk capital that is more patient, also help us to internally build that capacity, because that was one of the key constraints that we had, to really bring everyone together. But at the same time, also the fact that we were able to coordinate it very well to make sure that everyone played their role in the entire process to make this project successful. Now, again, at the end of the day, there are valuable insights that came out of it, but everyone that was involved, from origination team, credit scoring team, they would actually attest the value that we got from the insights into their work right now, and the way we look at that customer journey, reducing the friction, increasing the ability for customer to actually go through the entire process, lower rejection rates, and customer satisfaction at the end of it all. So that is the benefit that we've seen, and now we're taking all those learnings into the way we do first time newly onboarded customers on our platform, to basically understand their risk, but also comprehend and balance it with the experience that we give them, making sure they are responsible customers, and also making sure that we don't lose money. And so that's really what I would say has been the biggest success in terms of the way we look at the bigger picture, especially in considerations of such a project. I think the biggest one, of course, is how do we balance customer experience with, at the same time, responsible lending. And also for us as a company, portfolio quality is now the focus of how we look at our business going forward. And that requires, back to Rebecca's point, just to echo that, that requires a lot of risk capital and support. If we were to think about how do we scale these insights to markets, different markets that we continue to see a lot of fragmentations, fast loss guarantee will really be needed to blend the right financing in scaling such projects. And that's really where we are in how we're looking at the next stage of such experiments and the and the results into our work moving forward.
Great. Yeah, and I think, your point about, the collaboration across teams that you had an experience, I think that does point to, and even some of what Rebecca was saying about the multitude of those design choices and how like subtle parts of the different pieces can really drive very different outcomes for consumers. But, when approaching it from kind of that consumer outcome mindset, I guess trying to bring together all that on the back end to see, really what the customer experience is throughout and how that can drive kind of different choices for them. And I'm glad that you kind of started to touch on scaling, because I know we only have about 5 minutes left. Session's going much quicker than I expected. But yeah, I think in terms of your comments on kind of the needs for different types of financing to drive this sort of adoption is very useful. And I think, Rebecca, maybe I'll go back to you and also think in terms of scaling, kind of this, the findings from this specific sort of experiment, but also just, scaling the ability to take, to test these sort of approaches and convince others to invest in them. Just any thoughts on, what stakeholders should be engaged, how they should be engaged, and like steps that can be taken to really keep spreading this idea and hopefully identify new use cases and value.
Yeah, no, and Hilda, I really liked what you said towards the end there about, different types of capital being needed. I think for me, at least, the lesson from this experiment was less about, the actual results of the study, which might have some limitations in terms of being able to replicate, but more about just the value of the experience for the company, and just hearing this testament to how how it was a new way of working across so many different teams, but at the end it sounded like people really did understand the value and got value out of the process. So I love this idea of scaling the approach, right? So we should all be looking at we should be looking at all of the constraints or challenges that we face through this same kind of like user-centric testing approach. And I think that that's going to end up with better outcomes for consumers, which will ultimately lead to better outcomes for companies. And so, this really is just a call for investors, for companies to, leverage the data that's being generated by these new types of products. There's so much there that we can learn. There's so much there that we can use to create better experiences for customers. We just, we need the ecosystem together to prioritize that type of testing and research.
Great. Yeah, and Hilda, I guess, from your side, if, as we only have a few minutes left, would there be any kind of, call to action you would have to any specific group that's listening, to the broader kind of sector? But yeah, in terms of enabling these and having other providers, more likely to kind of come on board and engage with this sort of research.
Yeah, I mean, we basically are at the stage where we've learned, how do we embed this education into our products, and we've ended up launching a financial literacy tool embedded into the way we onboard customers. We've now launched Elimisa that allows us to basically educate the customer throughout the process, and that takes a lot of work and collaboration with other parties. So we're very excited about that. So for me, the call to action is we need to invest. We need to invest in such experimentation without penalizing risk-taking, to really then allow for that inclusive and sustainable credit ecosystems to be built. And I think if we stop these experimentations and just end at the level of, these are the results, everyone, go home and implement, and we stop there, I think we will miss out the bigger picture. And there's a lot of people that need to come in, that risk capital, regulation flexibility, because now we're regulated in under the digital lenders license. There's quite a lot of work there, consumer protection, and many other pieces that companies like ours are still figuring out, because this is almost the first time we're dealing with compliance and regulation nuances. But importantly, innovating responsibly and balancing that with the continuous experimentation in an agile way, but really maintaining those standards at the same time. So my encouragement and call of action to funders, regulators, and fintechs, and all of us as stakeholders, is to join hands and basically allow and encourage such experimentations without penalizing the risk, but also to support with risk, capital, and flexibilities that allows these models to scale.
Great. Great. Well, I know there was some other things we'd hope to cover, and there's plenty more discussion to go on around this. And I think specifically, this was a very kind of targeted use of this concept in digital credit. But I think, like we've touched on, we do see that there's many other ways this concept could be applied within credit, with savings, with payments, and just more broadly looking at these subtle design choices and embedding those kind of earlier in the product design and service life cycle to really make sure that these issues are kind of core instead of added on afterwards. But yeah, I know we're about to wrap up. So thank you both so much for your inputs. Thank you to the audience. Sorry we did not have a chance to get to questions, but yeah, I appreciate everybody's time, and we'd love to continue engaging. And as I mentioned, we have a report available on our website now. And yeah, we hope everybody listening can continue to drive these ideas forward or follow up with us with questions or ways to take things forward. So thank you all so much. Appreciate it very much.